For decades, the Wall Street analyst was the gatekeeper of the markets. When a lead analyst at Goldman Sachs or JP Morgan issued a buy rating, billions of dollars moved in an instant. At the peak, the most respected analysts commanded over $1 million a year in total compensation. Investors trusted every word they said. There was just one problem: those words weren't worth it. Most people think AI is coming to destroy a prestigious thinking job. They're wrong. AI isn't arriving to destroy something valuable. It's arriving to expose a multi-billion-dollar industry that has been hollow for years. Today, we look at the data Wall Street doesn't want you to see, and why the collapse of the Wall Street analyst isn't just happening, it's overdue. To understand why this collapse is earned, we have to start with a number that should not exist. In any rational market, buy and sell ratings should be roughly balanced. If analysts are giving honest assessments, you'd expect roughly as many warnings as recommendations. On Wall Street, buy ratings outnumber sells by 7 to 1. 7 to 1. That is not research. That is marketing. And it wasn't an accident. It was a structural conflict baked into the foundation of how investment banks make money. The analyst worked for a bank that desperately needed to win investment banking business. IPOs, mergers, bond issuances, from the very same companies the analyst was supposed to be rating objectively. Downgrade a company? Risk losing a $100 million banking mandate. Issue a buy rating, secure the relationship. This dynamic wasn't theoretical. During the dot-com era, analysts publicly rated companies as buy while privately describing them in internal emails as, and I'm quoting, a piece of junk. The analyst wasn't a prophet. They were a high-paid salesperson in a Patagonia vest. The question was never if this would collapse. It was when. While the world blames AI today, the real executioner arrived in 2018 with a piece of European legislation called MiFID II. Before this, banks bundled research costs invisibly inside trading commissions. Clients paid for research without ever seeing the price tag. It was hidden money, and it was keeping the entire analyst industry alive. When regulators forced banks to charge an explicit, transparent price for their research, the market gave its verdict immediately. Research spending across Europe fell by 25 to 30% within 2 years. Hundreds of analyst roles were cut. Research desks that had operated for decades were consolidated or shut down entirely. For the first time, institutional investors had to look at an analyst's report and answer a simple question. Is this insight actually worth what we're paying for it? The answer, overwhelmingly, was no. The research that banks had claimed was worth tens of thousands of dollars a year was suddenly being repriced to a fraction of that. In some cases, pennies on the dollar. The market had quietly known this for decades. MiFID II just forced everyone to admit it out loud. American banks were largely exempt from MiFID II. Wall Street exhaled. They thought they had survived. They were watching Brussels. They should have been watching San Francisco. What does a junior analyst at a major investment bank actually do for $200,000 a year? The answer is not what you'd expect. Studies show approximately 80% of a junior analyst's week is consumed by 3 tasks: gathering data from public filings, updating a financial model, the same spreadsheet with new numbers, and reformatting that model into a report template, one that was already formatted last quarter. Step 1. Pull the earnings data from the SEC filing. Step 2. Plug it into the existing model. Step 3. Write the commentary section. Step 4. Compliance review. Step 5. Publish the report. In a 90-hour week, and yes, analysts regularly work 90 hours, perhaps 10 of those hours involve genuine analytical judgment. The rest is mechanical, highly paid, highly stressed, deeply mechanical. This is precisely why AI is so lethal to this profession. It isn't destroying a thinking job. It's automating the part that was never thinking to begin with. Goldman Sachs disclosed that its internal AI tools can produce an IPO prospectus, work that previously required 360 hours of junior analyst time, in minutes. Morgan Stanley deployed an AI assistant powered by GPT-4 to over 16,000 financial advisors. It reads the entire Morgan Stanley research library, tens of thousands of reports, and synthesizes the answer to any client question instantly. JP Morgan's Koyfin system reviews 12,000 credit agreements per year, a task that previously consumed 360,000 hours of human time annually, now done in seconds. Bloomberg launched Bloomberg GPT, a 50 billion parameter language model, trained exclusively on decades of financial data. It writes earnings previews, analyses, SEC filings, summarizes Federal Reserve statements with citations. And the job posting data reflects exactly what the technology suggests. Entry-level finance analyst roles have declined by over 50% since their 2022 peak. Major banks are running teams of 2 analysts and 3 AI tools, where those same teams had 6 analysts just 4 years ago. The tools are not coming. They are already deployed inside the very banks that still employ analysts. The AI and the analyst are already sharing the same office. If the analyst class is collapsing, who wins? You do. The research that used to cost institutional investors $25,000 a year in Bloomberg Terminal subscriptions is being commoditized, and it is now available, free or near free, to anyone with a laptop. Tools like Koyfin, simplywall.st, and Tikr Terminal now provide the same financial data, the same earnings models, and the same company comparisons that used to be locked behind institutional relationships and 6-figure subscriptions. The DCF model that used to take a junior analyst 40 hours to build, an AI assistant now builds in 4 minutes. The sector comparison that required a dedicated research team is now a query in a chat window. We are entering the era of retail alpha. The tools of a $500,000 analyst are now sitting on your smartphone. The gatekeepers are gone. The data is finally yours. The only question that remains is whether you know what to do with it. Does this mean the analyst is extinct? Not quite. The survivor won't look like the analyst of the past. We are watching the rise of the Centaur analyst, named after the chess concept of human plus machine outperforming either one alone. The top 10 to 15% of analysts, those with genuine relationships, genuine judgment, and genuinely differentiated insight, are not being replaced by AI. They are being freed by it. The $500,000 star analyst who spent 40% of her week on spreadsheet maintenance now spends 100% of her time on judgment. She is more valuable, not less. But the other 85%, the mechanical middle, is gone, and it is not coming back. My prediction: within 5 years, the words "I read a research report" and "I asked an AI" will mean exactly the same thing. The middle class of finance research is dead. You will either be an AI, or you will be the person who tells the AI what to think. There is no longer any room for the mechanical middle. Wall Street is changing, and those who still rely on the old buy-sell report are going to get left behind. If you want to know exactly which AI tools are worth using to build your own research desk, subscribe to FINAI. We cover the data that isn't in the headlines. New video every week. You're a Demon. We'll see you then.